Good morning, everyone. This is Hope Atwell with AREAA National. Thank you for dialing in for today's AREAA Commercial webinar series talking about the commercial real estate outlook. It is 8:58, so we will be starting in a couple of minutes, but just some kind of like housekeeping items before I turn it over to Kurt Nishimura, who is the chair of the commercial committee this year through next year. Everybody is muted right now, except for the presenters, for Rick, for Mike, and for Kurt. If you have a question to ask any of the presenters, you have the ability to type in your questions on the icon below, which is the chat. The presenter should be able to see your questions and address those questions and answer those questions when we see them. The webinar is also being recorded, so we will be posting the webinar sometime today. The PowerPoint slides will also be made available to all of the participants. So that will be shared and posted on the website as well. And look out for an email that will be sent out shortly after today's webinar. So with that, let me just unmute Rick and Kurt and also Mike. And we can get started. Kurt?
I'm the
Sorry. Kurt, good morning. Hi, it's Hope. So you, Mike, and also Rick should be unmuted at this point. So I will turn it over to you, Kurt.
Great, thank you. Hi, my name is Kurt Nishimura. I'm from AREAA Greater Phoenix. I am the commercial chair for 2018. I wanted to thank Eugene Wang, who was the commercial chair for 2017, that did a great job. I want to continue a lot of the initiatives that he did during his time and initiatives that were done by past chair people for commercial. This is something that we've had a commercial chair dedicated position at the national level for about 5 years now, and we continue to get more people involved in commercial real estate to join AREAA, and we want to continue to offer valuable things like this webinar and some of the breakout sessions we have at the Global Summit and National Convention to continue to add to our commercial membership. We're very, very fortunate to have the support of RE/MAX Commercial and Ten-X to give us this webinar. And what I'd like to do at this time is introduce Mike Reagan. He is the Senior Vice President of Business Alliances for RE/MAX Commercial. Mike oversees the Global Alliance programs that have helped make RE/MAX one of the most recognized real estate brands in the world. He also leads RE/MAX Commercial, which is under his direction has grown into one of the top 20 commercial brokerage networks in the world and represents RE/MAX on the industry advisory board, including AREAA. As part of his RE/MAX career, Mike joined RE/MAX in 1990 and in 2009 began leading RE/MAX Commercial Network in 2009. His direction has been the driving force behind the division's dramatic expansion in membership, visibility, and services. In 2012, his team launched RE/MAXCommercial.com site, which now promotes more than 250,000 commercial listings and represents a key competitive advantage for RE/MAX commercial practitioners. Mike's leadership has established RE/MAX as a leading contributor to the Children's Miracle Network hospitals, which each year help over 10 million families at 107 hospitals throughout North America. RE/MAX affiliates have donated more than $157 million in Children's Miracle Network hospitals since 1992. and Mike is in Colorado. So it's my great pleasure to introduce Mike Reagan from RE/MAX Commercial.
Great. Thank you, Kurt. Good morning or afternoon, whichever's the case. Good morning to everyone. You know, RE/MAX is very proud of our partnership with AREAA, and we appreciate the fact that they are increasing opportunities for commercial brokers as we look into 2018. Through Kurt's leadership and a focus on education and networking, AREAA members will benefit by adding commercial practitioners to their business network. This is going to be great for referrals. With more than $11 billion in sales and lease volume, one of the benefits of RE/MAX Commercial is our presence in more than 100 countries and territories. And like AREAA, our practitioners benefit from this powerful referral network. We welcome you to take a look at RE/MAX Commercial by visiting remaxcommercial.com. You know, many of us attended a number of industry events in the fall, and by most indication, the commercial market continues to be strong. All the forecasts look good for 2018 in most segments. You know, there's a great deal of focus on technology, and everybody's topic on the top of their mind is the future of retail. And we've got a great speaker today to guide us through these opportunities. Let's welcome Rick Sharga, Executive Vice President of Ten-X. And of course, Ten-X is a leading online real estate marketplace. You know, Rick has gotten to be a good friend of RE/MAX Commercial, and he was at our symposium recently, did an amazing job. He's one of the most sought-after speakers and most often quoted experts in real estate, mortgage, and especially trends in commercial. Rick serves the industry in many ways, and we're both proud to serve on the Corporate Advisory Council of AREAA. So let's give a warm welcome to Mr. Rick Sharga. Rick?
Thank you, Mike, for that gracious introduction, and thank you to AREAA for inviting me to participate in this morning's, or as Mike said, this afternoon's session. We at Ten-X, excuse me, have sold about $18 billion of commercial real estate on our Ten-X commercial platform, and welcome the opportunity to work with brokers across the country to help them deliver the best results for their clients as well. I'm going to share with you some research that's primarily from our Ten-X research group this morning, talking about what we see happening in the broad commercial real estate market, and specifically what we see happening in some of the main sectors of that market. We have probably too many slides to get through in the time allocated, so I apologize in advance if I gloss over some of the things you might be interested in, but as Hope mentioned earlier, the slides will be made available after the webinar, and my contact information is included in the deck if anybody has any questions for me after we get done. In addition, we'll be fielding some questions at the very end. I don't usually do disclaimers before I do a session like this, but I'm going to do one right now. We're not really good at predicting the unpredictable, and there are really two or three things that are weighing on the commercial and residential real estate markets that are a little difficult to predict right now. None of the numbers we have in our deck today, excuse me, reflect any of the fallout from the hurricanes that recently battered Texas and Florida. So it's very likely that there's going to be some static, some distortion in the numbers as markets recover from those natural disasters. Then there's an unnatural disaster taking place in our nation's capital right now, and it's partly in the form of a tax reform bill that will absolutely have some impact on real estate, but until we get the details of what the reconciled bill between the House and the Senate is, it's really almost impossible to project exactly what the impact's going to be. The press has been covering a lot about the potential impacts on the residential market. That certainly has some fallout for aspects of the commercial market, most notably in the apartment sector, the retail sector, and the office sector. But again, until we get the details of the tax package, it's really going to be difficult to figure out exactly what the impact is going to be on commercial. So I say that with just a note of caution as we get into the numbers that some of these things are subject to change as we go forward based on things we simply can't control. With that said, if I can move this forward, we will. There we go. Let's take a look at the overall market right now. We are in an improving market. It's still a fairly strong market. The deal volume in the third quarter across the country exceeded $109 billion. It was the second consecutive quarter of quarterly growth, which is good. It's still 10% below where we were a year ago, though. And so the deal volume, the dollar volume, is not keeping pace with where we were a year ago. And this goes across all market sectors. So we're coming back from what appears to have been a bottoming out in the first quarter of this year, in the February time period. As you all know, typically this is a very seasonal market. We can expect deal volume to perk up again in December, as it often does. But if you take a look at the brackets on this chart, September compared to September, you can see that we're not really keeping pace with where we were a year ago. So while the short-term trends, the quarter-over-quarter trends look pretty good, the year-over-year trends are a little bit less positive. And this is probably no surprise to any of you who work in the commercial space, but the deal volume does have a tendency to vary pretty greatly by sector. Again, we're up about 3.2% from the prior quarter. The industrial and retail sectors grew in terms of overall sales during that quarter. The apartment, hotel, and office sectors shrank in terms of overall deal volume. And I apologize if the chart's a little hard to read. It may be better on your screens than mine, actually. But the light blue area here is office sales. The yellow is industrial sales. The darker blue is retail. Green is apartment, and red is hotel. And as you can tell, there's been a little bit of compression in the office category, as we've been talking about. There is a growing amount of sales in the industrial sector, although there's some conflicting data there that we'll go through in a minute. But again, it's wide variety of types, and we see a little bit of variability too in terms of the regions. We're not going to get into that too much today. But for example, in the retail sector, the western region is doing very, very well right now. The south seems to be recuperating. Coming out of the hurricanes, the Northeast not doing very well at all, and again, a shift in the types of retail properties that are being sold, and just some variability in the numbers that are just beneath the surface. Retail pricing apparently is going up more quickly than some of the other sectors, almost 6% year-over-year price increases. But one of the reasons for that is there's very little retail development going on. So you're not looking at an overload of supply knocking down prices across the board. So be careful when you're looking at numbers and some of these things, because they can be a little bit misleading. Longer term, one of the interesting things, I love our research team because they give me charts that are almost impossible to interpret, or like Rorschach tests, so that you can basically make them mean whatever you like. But this one in particular is kind of interesting to me because it shows the share of market within each of the sectors. And it clearly shows you, if you take a look at the light blue sector, that the office market has really dropped considerably below where it's been historically in terms of the share of overall commercial deals. You can see that retail, while we're seeing good pricing, the volume of deals has dropped a bit. And what we are seeing is multifamily still being very, very strong. Hotels kind of lagging a little bit, but not falling precipitously quarter over quarter like we saw in the office sector. We'll get into some of the trends that are affecting these shares of market as we get into the sector by sector analysis going forward. So I'm not going to spend an awful lot of time on that. We did also come across an interesting study that AREAA put out to investors in commercial real estate. And interestingly, they view the apartment and industrial sectors the most highly right now on a scale of 1 to 10, with 10 being the best investment opportunities. What you can see is that the industrial and the multifamily or apartment sector were both in the 7+ range, whereas the hotel sector, the office sector, and the retail sector we're well below that. In fact, retail sector in terms of long-term attractiveness was below 5 on a scale of 1 to 10. So there is still a significant amount of belief. And what's also interesting to me is the differences in the year-over-year changes over the last 4 years that NREI has been doing the studies. You can see that multifamily has been pretty consistent. The variability only from 7.8 to 8%. But look at the fall off in retail, which is statistically significant, and look at the difference in what we're seeing on the industrial side. And again, some factors that are also tied into the drop in retail that are benefiting the industrial sector come to bear. But it'd be interesting to understand how these views track compared to what you're seeing in your local markets, and we can talk about that a little later. We do something called a nowcast that marries Google search data, some information from Citus, our own online sales and search activity, and general pricing information as it's being reported, to come up with an index that suggests which way commercial real estate prices are trending. In this particular case, what we saw in November was that pricing remains weak. We're in the 7th consecutive month of price declines. That still leaves us up about 1.5% overall on a year-over-year basis. But as you can see, virtually every category has dropped in terms of pricing, except, interestingly enough, retail, which, again, is going up significantly on a year-over-year basis, but against a much smaller volume of sales. But pricing across the board, across the country, has dipped significantly over the last 7 months. And it really does appear that pricing nationally may have peaked last year. We're not anticipating, and there's nothing in the numbers to suggest an enormous fall off like we saw back in the 08-09 market bust. But it does look like the market is normalizing a little bit right now. And part of this, too, is keep in mind that the commercial space over the last few years has probably outpaced the fundamentals. And by that I mean that the prices rose and sales volume was a little bit more rapid than we might have expected from the underlying economics that drive each of those sectors. Part of that was probably due to the fact that capital was so widely available and so inexpensive. And so people were kind of hedging their bets as they were making these investments and factoring in the low cost of capital as a way to justify higher prices. But it does appear that in virtually all the categories we may have hit market peak and are on our way back down to a more normalized level of pricing. Not surprisingly, the cap rates have been kind of flat during this period, and I say not surprisingly because cap rates are tied pretty closely to Treasury yields, and Treasury yields have been flat for the last quarter, running at about 2.2%. This is one of the factors that we look at when we're concerned a little bit about tax reform, and we're concerned a little bit about Fed funds activity over the next year. Both of those could have an impact on Treasury yields, which would also have an impact on cap rates. But in every sector across the board, cap rates are running below their 10-year averages. So that's what you're looking at with the black dot that's running above all those columns. That's the 10-year running average of cap rates. And as an investor looking to buy properties, when you're looking at a sector where your cap rates are at 5, as they are in the apartment category or in the 5s in some of the other categories, it takes a certain type of investor with a certain type of faith to jump into a market looking at cap rates along those lines. So the cap rates and the risk premiums that probably indicated that people are buying a little bit above what the economics would suggest. So the bottom line with all that is the market remains reasonably healthy. We are seeing prices soften, but we're not concerned that we're going to see an enormous fall off in terms of pricing activity. And we'll get in a little bit of the market by market insights we have from 10X Research in the next section here. We are looking at the tail end of a boom in terms of apartment development. That should by itself cause a little bit of an increase in vacancies. And if we do happen to have an economic downturn, that would obviously become more of an issue. I'm calling in today to this webinar from a single-family rental investment forum in Scottsdale, Arizona. And the other thing that could become an issue for the apartment sector is the growing number of single-family residences that are being rented out. That number has grown from about 12 million in 2009 to about 16 million today, and it does appear that number will continue to grow as people, as investors find the opportunity lucrative, and as families opt to rent a house instead of renting a 2 or 3 bedroom apartment. So something else to keep in mind as the market moves forward is the supply coming to market is not just the multifamily units being built, but it's also the single-family homes coming onto the market. We're still waiting for the millennials to move out of mom and dad's basement. They are starting to do so. They currently do represent the largest group of home buyers coming into the market. Last number I saw was about 42% of buyers today are millennials, and about 2/3 of the first-time home buyers are millennials. But as they're moving out, they're not all buying. They are renting as well. We're still looking at about 30% of young adults living at home with their folks, which is still about the highest it's been. It's dipped a couple percentage points, but it's still very high. But those numbers are gradually coming down, and the millennials are gradually moving out, and that should spell opportunity for people in the apartment segment. Single-family purchase affordability, just to kind of make sure we're all on the same page on that point. In most markets, it's still a little bit more affordable to buy than it is to rent. That does not apply in every market equally, but generally speaking, across the country, most markets still a little bit better to buy than to rent if you're looking at it economically. But we are seeing affordability levels come down on the single-family purchase side as home prices go up. And so that could be a positive impact for apartments as we go forward. We're still looking at home ownership rates, even though they've been ticking up slightly, that are close to the lowest they've been in the last 30 or 40 years. Household formation and that's the number of new households being formed, whether they're renter households or owner-occupied households, is starting to come back. It's still short of where we would normally see it over the course of a year. And again, that's partly because we do have so many of those young adults staying home with their folks. A lot more multi-generational households than we've seen in previous cycles. But as household formation improves, those folks are going to need somewhere to live. And right now, a higher percentage than we've seen in the last 30 or 40 years are opting to rent. I should point out that over the last 4 quarters, I believe now, we've seen a greater increase in owner-occupied households among new households being formed than we've seen among renter households. And that's the first time we've seen that in several years, really since the housing market crashed in 2008. So it could be that we're getting back to that that longer-term trend that we saw right up until the housing bust. But it's probably still a little bit too early to call that. It's something we'll be keeping our eye on as we go forward. What my research colleagues are referring to by the late cycle is that we're toward the end, we believe, of the buildup of the supply coming to market, and we are seeing on the chart on the left that supply is continuing to come to market at a rate that outpaces demand, but it is starting to slow down, and we anticipate that we'll reach equilibrium pretty soon. In the meanwhile, even though apartment vacancy rates are up a little bit, and I say that advisedly, it's just very little bit, we're still seeing apartment rental rates go up significantly. So for investors buying these multifamily units, the returns have still been pretty good. And we talked about this a bit, household formations. We talked about millennials coming into the market, and they do represent the largest age cohort now. And will be the driving force, whether you're talking about single-family sales, single-family rentals, or apartment rentals over the next decade. Talked a little bit about this as well. We expect vacancy rates will continue to grow. We've been at historically low vacancy rates for several years. In a number of those years, according to REIS reports, we were down in the 3% range, which is simply unheard of. As the balance of this supply comes to market, as the single-family properties come to market, we could see rental vacancy rates go up as high as 6%, which gets us back close to normal levels. levels that we've seen historically. But we'll also see demand pick up in a couple of years just due to demographics and population age and activity cycles. And so we should be able to see that equilibrium over the next couple of years. But keep in mind that as I mentioned beforehand, we do know that some inventory was wiped out due to some of the natural disasters. I didn't even mention the fires in Northern California. There's some burning in Southern California today. So some supply is being removed kind of by artificial means as we go forward. And it does look like the building of new inventory is slowing down to accommodate changes in the market. If you guys are interested in this sort of information, we publish free quarterly reports on each of the sectors. You can go to 10x.com to the commercial site and actually sign up for these reports. They're free, and you'll get them emailed to you. And among other things, what each of the report does is talk about the markets where investors might want to consider buying or selling assets within a given market sector. This is a kind of snapshot of what it looks like nationally. So if you're looking at a red market in here, some of the markets in the Northeast perhaps, or in the West, it shows where we think the fundamentals aren't great to be a current buyer of multifamily properties. If you're looking at a market that might be a better opportunity to buy in right now, you're going to look at green. But the red markets are opportunities for brokers because that suggests that maybe it'd be a good time for your clients to consider selling and cashing in on their investment. So we have these for all the categories. I'm not going to spend a lot of time on them because you can take a look at them yourselves. But we do break it out by sector and by market opportunity. The office segment is doing okay, but not great. The overall numbers probably mask what is a weakness. This is a market sector that we think probably has a lot of volatility across the country. Some markets are doing very, very well. Some markets are doing very, very poorly. So that the blended numbers look a lot better than it might look in any given market. We are seeing that we're seeing more supply come into the market, which in some cases may be poorly timed, but it is what it is. And demand is not likely to grow as fast as this supply because we're at a point now with 4.1% unemployment where we have a virtually full employment situation. So building more office units at a time when the space per office worker is going down, and there may not be that many more office workers coming into the workforce, really does suggest there might be some pressure on this segment as we move forward. So what I was just talking about, you take a look at floor plans today, you're seeing a significant reduction in the amount of space required per worker. And sometimes it's kind of silly when you think about the obvious things that we all overlook. I was looking at these notes earlier, and it reminded me, I don't know the last time I've seen a file cabinet in an office. As storage of files has gone almost 100% digital, all that room that we used to have storage rooms full of file cabinets. They're gone. The file cabinets that took up space in an office environment are gone, and we've moved to more open office environments. So those hallways that used to be littered with file cabinets are now littered with desks and workstations. And because of that, the average square foot per worker has dropped from 225 square feet in 2010 to 151 square feet today. So you're looking at some workforce changes. You're looking at structural changes in the layouts of modern office environments, and you're looking at fewer offices, more collaborative work areas, and again, just some fundamental shifts in things like as basic as storage units. So all that conspires to say that if you have a building with X number of thousands of square feet, it's going to fit more office workers than it used to, and that's going to take that demand away from another office somewhere. Also suggests that any of your clients who own office buildings are probably going to have to be looking at a lot of retrofitting going forward to meet the demands and the needs of the businesses today. Vacancies are flat. Rent growth is still taking place, but it's decelerating. So what that means is is rents are still going up, but much more slowly. And as I just mentioned, in a lot of cases, to retain those tenants, building owners are having to put in significant upgrades to accommodate the technology and office flexibility demands of their tenants. We'll see what happens to vacancies as supply continues to come in. And again, this is one sector where supply seems to be growing a little bit faster than demand, and it'll be interesting to see what that does to pricing as we go forward. We're also seeing a little bit of strength in suburban office pricing. So there's still a premium for central business district office pricing, but it is getting narrower and narrower, and we are seeing in some markets where you have high walkability scores, the pricing is actually stronger than some of the traditional suburban pricing that we've seen. I work in an area in Southern California where you literally have to drive to get everywhere, and it is a pain. And you kind of miss that central business district environment as a worker, as an employee. But we are seeing a lot of suburban areas build that into their new developments, and the pricing reflects that. Because of what I said earlier in terms of supply probably outpacing demand a bit, we are suggesting that the office market is a bit weaker than some of the other sectors right now. If you're looking at a positive outlook, our call is for Portland. So don't everybody leave and go to Portland today. But again, as our current president has mentioned, people can make money in a tight real estate market and in a fast-growing real estate market. So having the information you need to work with your clients should give you and them a competitive advantage. Retail has been in all the news. We're seeing the Southwest and Southeast because of population growth, seeing a little bit of growth. We're seeing the West having a little bit of a rebirth. But brick and mortar in general has been hurt pretty significantly by e-commerce. E-commerce numbers continue to grow. We just set a record on Cyber Monday, biggest single day of online sales, and I believe the biggest single day of retail sales ever. And so there is no denying the fact that more and more people are opting. I started my Christmas shopping online at home on Thanksgiving. So we are seeing a lot more of that. We are seeing the big box stores continue to struggle and make thousands and thousands and thousands and thousands of square feet of what used to be prime retail space suddenly available. The suburban malls are suffering quite a bit, in a lot of cases being repurposed to multi-use facilities, and in some cases even including housing. I know some investors who swear that suburban malls are going to be the housing for seniors going forward. We'll see how that all works out. So rent rates are going up probably more slowly in this sector than in most other sectors. We are not seeing a ton of new supply come into the market, but demand is even weaker. So it really, what's selling right now is selling in prime locations, and I believe that's one of the reasons we've seen the prices rise as quickly as they have. But you're seeing, and these numbers are all over the place. So these are just the numbers that we look at. But if you're looking at e-retail now, e-sales outside of pretty much everything but automotive, you're looking at them making up at least 14%, and growing at 11% a year. So that genie is out of the lamp. What's fascinating is seeing companies like Amazon now starting to open brick and mortar stores, buying outfits like Whole Foods that you can use for pickup or return. Just fascinating to watch this whole thing unfold, but it is fundamentally shifting the footprint of retail in a way that will not change anytime soon, change back anytime soon. I mentioned earlier that malls are suffering quite a bit. Their anchor tenants are really struggling the most. And look at that chart in the bottom of this slide that shows what department sales have done over the last 25 years. It's just an enormous drop-off. Everybody used to go to Macy's, used to go to Sears. I mean, my family, as I was a young boy growing up, Sears was the place to shop, and you can't even find a Sears today. So big fundamental shifts in this industry that are having big shifts in the sales as well. probably not worth getting into this. This is kind of repetitive to what we just talked about. Again, Southwest, Southeast, because of population growth, we're seeing some markets being a little stronger than others. The Midwest, Northeast, retail really suffering quite a bit. And in the West, some markets, LA, San Diego, you're seeing some modest growth. But by and large, this is it's a different retail market. So it's not the big boxes, it's not the suburban malls. Tends to be a lot of urban center, multi-use retail opportunities, and those are commanding pretty good dollar values as we go forward. Industrial segment, and I'm going to really kind of even speed it up a little bit further here because we're running out of time. The downfall of retail is actually the benefit of the industrial sector. We're seeing, with the advent of e-retail, a greater need for warehousing and distribution centers. So while the coastal California area, for example, we're seeing some of the stores struggle a little bit. The Inland Empire, Central Valley of California, we're seeing a boom in distribution centers and warehouses. So that's been a big fundamental shift in the industrial sector. We've also seen some other areas of industrial, that are driving things up, and that's why we're seeing more capacity, more supply coming to market, because we're seeing things like e-commerce, which we talked about a little bit here, and you're seeing the need for warehousing, for industrial sort of last mile opportunities for those delivery services to get from the web to the consumer at home. You're also seeing cloud computing grow, and as you see cloud computing grow, there becomes an enormous demand for data centers, which is where those clouds actually operate. They don't really operate in the clouds, for any of you who are confused. They're in these huge data centers. And you see on the left-hand side there where a lot of those data centers are. Not a huge surprise, Northern Virginia, Northern California, the Midwest. And it'd be interesting to see if Amazon doesn't locate somewhere similar to what we're seeing in terms of those markets for their next headquarters. So that's one of the other drivers, and there's another driver. I don't know if I cover here. I forget if we do or not. But it's the legalization of marijuana, which has created, and Mike Reagan and the folks at RE/MAX being in Denver are well aware of the shifts in the commercial and residential real estate market that legalization has resulted in the state of Colorado. But office space going up, warehousing space in particular going up, as the plants need some place to be cultivated indoors, manufacturing, distribution, all of that. So those are really three trends: e-commerce, cloud computing, and legalization of marijuana that have had a major impact on the industrial sector. And so because of that, you're seeing a lot of the supply that's coming to market being absorbed. And this is one of our more optimistic, if you will, sectors that you see much less dark red and even much less pink across the country. Interestingly, we've seen some of the pricing soften on industrial units. Could be that supplies come to the market a little bit more quickly. Could just be because a lot of the supplies in secondary and tertiary markets that the price per square foot's a little bit slower. So we are seeing a little
Mike.
bit. Yep.
Yeah, just offer one quick point. Obviously, Colorado has been pretty successful with the marijuana transition, but the folks should know that the marijuana laws for recreational use they're pending in 29 states. So one of the things we pointed out at our symposium when you were there was this is coming. It's coming to 29 states here in the next 18 months, and it does have an impact on zoning and industrial, and it's fairly complicated. So now's a good time for folks to start getting some basic education in this category.
That's a really, really great point, Mike. I appreciate your adding that context. And yeah, I forgot to mention that it is 29 states have the laws pending. And even some of the states that have limited legal marijuana for medical purposes, are seeing some shifts in those zoning and industrial real estate operations. Finally, the hospitality segment. We sell a ton of hotels excuse me, on our platform. And what we've seen is a lot of appetite for limited service hotels over the last year. I'm not sure exactly why, but we do see growing room demand there. The hotel sector tends to go up and down in terms of rooms rented, occupied rooms, based on economic fundamentals. And it tends to tie in closely to the GDP. But the business travel, the tourist travel has a tendency to be very, very heavily impacted by what's going on in the broader economy. So there is some volatility in this market, but right now it seems to be relatively stable. Consumer spending has continued to go up, although not in a straight line. Business travel is still relatively healthy, but you can see from the chart there on the right, it's kind of up and down, and again that kind of goes along the lines of the economic discussion I was kind of working my way through there a couple seconds ago. So we also have some unusual factors affecting the hotel industry. So this is one. Foreign travel, excuse me, has been doing very well in 2017 as the dollar value has gone down. Pardon me. But we'll see what happens now that the travel ban has been approved, and if that has any impact on foreign travel into the U.S. One of the things we really can't predict. Demand growth has slowed over the course of the year. And supply has not been overwhelming, so we're not seeing too much come onto the market in terms of new rooms as compared to what the demand has been. We're still in fairly good shape. Occupancies are expected to climb, although at a slower pace through next year. We're looking at the potential for the next recession being sometime in 2019. That would suggest that occupancy rates fall in 2019 or 2020. But for the next year or so, in any case, it looks like we should be in pretty good shape. And RevPAR growth looks like it will also continue to grow a little bit over the course of the next year. One of the things I wanted to point out here, too, is there's been significant impact, and we believe it will continue to grow, although it's hard to quantify, from Airbnb on the hotel sector. And there are something like 60,000 Airbnb units that basically replicate hotel services just in the major metro areas, and that number continues to grow pretty significantly. It'll be interesting to see over the long run how big a bite out of business travel the Airbnb sector and the variety of companies that are coming in to compete with Airbnb but offer more hotel-like services will have on this sector going forward. What you're seeing here, and the reason you're seeing a lot of the red here, is simply an aspect of the pricing. We believe hotel pricing has probably outpaced the underlying fundamentals, and again we look to think there might be a coming downturn in about 18 months. So again, for your traditional hotel sales, not a really optimistic time for buying activity in all but a handful of markets, but might be a good time for you as brokers to be going out talking to some of your clients about whether now might be a good time to get out and maximize their returns. So I apologize for kind of tripping over myself in that last sector. I was trying to kind of hurry up and get done because I know we're a little bit over time. But if again, there's some links here for the kind of research in more detail than I shared with you today that's available for free. And if you're interested in this kind of thing, I do tend to post a lot on Twitter and LinkedIn, so feel free to either follow me there or send out a note to connect with me in LinkedIn. I'll be happy to share our real estate thoughts with you as we go forward. So with that, I appreciate, again, the opportunity from AREAA and our friends, our partners at RE/MAX, and we'll turn this back over to Hope.
Hello, this is Courtney Shimura. I want to thank RE/MAX Commercial and also 10X for providing this valuable information during this webinar. There is the opportunity to ask questions. If you have anything, I haven't seen anything come through the chat, but if anyone would like to ask a question, we do have a little time to answer something. So please send a question in the next minute or so. If not, we can conclude the session. But one comment I did want to make about Airbnb is because of the significant impact it is having on the hotel industry, there's a lot of cities right now that are actually making it illegal to have Airbnb units because they do have to protect the bed taxes that the city collects that are a valuable part of city revenues. They're also trying to protect the hotel workers in many of these states where they're unionized. And without having guests coming into these hotels, obviously the hotel workers are at risk as well. So there's a lot of social implications that come with Airbnb. I know that the state of Arizona actually is very pro-Airbnb as of right now. The mayor of Phoenix has publicly stated that he thinks it's good for business and really likes the small entrepreneur to be able to have that opportunity. But there will be changes in the future as we see larger and larger impact from Airbnb. I haven't seen any questions come on through the chat channel, so Mike, do you have any closing thoughts, or Rick, would you like to add a closing thought before we close shop here?
No, Rick, great job as always. I think this is great information, and we appreciate 10X making it available to the marketplace on a regular basis.
And I think I've already exhausted my comments and perhaps have exhausted the people participating in the webinar.
Well, it looked like we had several people on the webinar. They are actually in mute mode, so unfortunately they cannot speak up. But we will have this recorded. It has been recorded, and we will make it available to people later this week. So if anyone would like a copy of the presentation or a review of the webinar, AREAA will certainly make that available. So thank you so much, and we look forward to our next webinar sometime in the future. Thank you.
Thank you.
Thank you.
Bye.